Hey there, future millionaires. What if I told you that the difference between building wealth and watching it vanish could come down to just a few simple mistakes? Whether you're a Wall Street wizard or just starting to explore the world of investing, there's a good chance you're making one of these costly errors and you might not even realize it. But don't worry, because today, in breaking down the top investing mistakes that could be sabotaging your financial future, stick around, because what you learn in the next few minutes could save you from losing thousands or even set you up for life. Trust me, you don't want to miss this. All right, let's dive right in. Mistake number 1, not having a plan. Imagine setting off on a road trip without a map or GPS. You might eventually get somewhere, but it probably won't be where you wanted to go. The same goes for investing. Without a clear plan, you are just throwing money at random opportunities and hoping for the best. Ask yourself, what are your financial goals? Are you saving for retirement, a house, or your kids' college fund? Your plan should align with your goals, risk tolerance, and time horizon. Without it, you're setting yourself up for failure. Now let's break this down a bit more. A good investment plan starts with understanding your risk tolerance. Are you comfortable with high risk, high reward investments? Or do you prefer steady, reliable returns? Next, consider your time horizon. If you're investing for retirement 30 years down the line, you can afford to take more risks than if you're saving for a house in the next 5 years. Finally, make sure your plan is flexible. Life happens, and your financial goals might change. Regularly review and adjust your plan to stay on track. Next up, mistake number 2, letting emotions drive your decisions. Ever heard of FOMO? Fear of missing out. It's real, and it can lead to terrible investment choices. Maybe you see a stock skyrocketing and jump in without doing your research, only to watch it crash the next day. Or maybe you panic sell during a market dip, locking in losses instead of riding out the storm. Remember, investing is a marathon, not a sprint. Stay calm, stick to your plan, and don't let emotions cloud your judgment. Let's talk about a real-world example. During the 2008 financial crisis, many investors panicked and sold their stocks at the bottom of the market. Those who held on and stayed the course saw their portfolios recover and even grow in the following years. The lesson here: emotional decisions can lead to significant losses. Instead, focus on the long term and avoid making impulsive moves based on short-term market fluctuations. Now let's talk about mistake number 3, putting all your eggs in one basket. Diversification is your best friend when it comes to investing. If you pour all your money into a single stock, sector, or even cryptocurrency, you're taking on unnecessary risk. What if that one investment tanks? Your entire portfolio could take a massive hit. Spread your investments across different asset classes, industries, and even geographic regions. That way, if one area underperforms, others can help balance it out. Think of diversification as a safety net. For example, if you invest solely in tech stocks and the tech sector takes a hit, your portfolio will suffer. But if you also have investments in healthcare, real estate, and international markets, the impact of a tech downturn will be less severe. Diversification doesn't guarantee profits or protect against all losses, but it's a crucial strategy for managing risk. Mistake number 4, ignoring fees and taxes. Hey, race the thing, fees and taxes can eat into your returns faster than you think. High management fees, trading commissions, and even tax inefficiencies can add up over time. For example, if you're constantly buying and selling stocks, you could be hit with short-term capital gains taxes, which are higher than long-term rates. Always read the fine print. Choose low-cost investment options like index funds, and consider tax-efficient strategies, like holding investments for the long term. Let's put this into perspective. Imagine you have 2 mutual funds with similar performance, but one has an expense ratio of 0.5 and the other charges 1.5. Over 20 years, that one difference could cost you tens of thousands of dollars in lost returns. Similarly, frequent trading can trigger capital gains taxes, which can significantly reduce your net returns. Be mindful of the costs associated with your investments and look for ways to minimize them. And finally, mistake number 5, chasing trends without doing your homework. Just because everyone on social media is talking about the next hot stock or cryptocurrency doesn't mean it's a good investment. Remember GameStop or NFTs. While some people made money, many others lost big because they jumped on the bandwagon without understanding what they were investing in. Always do your own research. Look at the fundamentals. Understand the risks. And don't invest in something just because it's trendy. Let's take a closer look at this. When you hear about a trending investment, ask yourself what's driving the hype. Is it based on solid fundamentals? Or is it just speculation? For example, during the crypto boom, many people invested in Bitcoin and other cryptocurrencies without understanding how they work or the risks involved. While some made significant gains, others lost everything when the market corrected. The key takeaway: don't let FOMO dictate your investment decisions. Take the time to research and understand what you're investing in. So, there you have it, 5 common investing mistakes that could be costing you big time. To recap, have a plan. Keep your emotions in check. Diversify your portfolio. Watch out for fees and taxes. Do your homework before investing. But wait, there's more. Let's talk about a bonus mistake: not reviewing your portfolio regularly. Even the best laid plans need adjustments. Market conditions change. Your financial goals evolve. And your risk tolerance might shift over time. Make it a habit to review your portfolio at least once a year. Rebalance if necessary. And ensure your investments are still aligned with your goals. Another bonus tip: don't try to time the market. Even the most experienced investors struggle to predict market movements. Instead of trying to buy low and sell high, focus on time in the market. Historically, the longer you stay invested, the better your chances of achieving positive returns. Remember, it's not about timing the market. It's about time in the market. All right, let's wrap this up. Investing can be a powerful tool for building wealth, but it's not without its pitfalls. By avoiding these common mistakes, you'll be well on your way to building a stronger, more resilient portfolio. And hey, if you found this video helpful, don't forget to hit that like button, subscribe, and share it with a friend who's just starting their investing journey. Thanks for watching. And remember, smart investing starts with avoiding the mistakes that trip most people up. See you next time.